So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome, everybody. Merrill Chandler, your host of the Are You Effable podcast. Now, today is the day of the interview of interviews. I'm in the New York Hilton Hotel in Midtown, and where FICO is hosting their FICO World 2019 Decisions Conference, and I'm in one of their meeting rooms. I'm going to be joined shortly by the individual I've quoted a dozen times, if I've quoted him once, David Smith. He's the chief consultant for the FICO originations for the SBSS Business Credit Scoring service. So when we come back, we're going to go into that interview, and you'll get to hear for yourself the things that you need to watch for on business credit scoring and how things are going to roll out over the next few months and years. So I'll see you back in just a minute. Welcome back, everybody. Merrill Chandler, your host of Are You Effable. Now, I've been leading into this one for a minute. A couple of podcasts ago, I just mentioned that David had said yes, and that was just like a proposal of marriage for me. So I am so excited. I want to introduce you to David Smith. I'll let him tell you his role, how he works at FICO, but I have quoted him a number of times about that 80% of all business lending decisions for small and medium businesses, or small and entrepreneurial business, rely on the personal FICO score. This is the man and the myth. So
a lot more myth than man, let me tell you.
Right. So thank you for joining me. This is I know the last time I met with a bunch of the executives, they had what I call the IP protector, right? He was the guy to make sure no one's letting the cat out of the bag.
Right.
So we don't have one of those today, so it's all on the line. No, I'm just thrilled that you've been able to join me.
It's my pleasure, Merrill. I really do enjoy these types of conversations, and I talk to banks a lot, but talking to the borrower is sort of my new thing this year. I want to get more into talking to banks about the customer experience during the application process, and then driving that education back to the borrower as to why are we doing what we're doing, what data are we looking at, and why.
Right? You see why I love this guy. Seriously. And FICO, I was literally downstairs eating lunch. A gentleman walks up to me. He's like the vice president in the analytics department. He's like, "Hi, my name's Alan." And I'm like, "Hi, Merrill Chandler. You guys are all so nice. Do you have like corporate, sensitivity training or what
we
goes on
hire
here?"
well, and everybody we work with is smarter than we are. So it really is one of those things. Every time you meet somebody at FICO, they're smarter than you. It's just one of those things. We're pleasant to be around. We have great customers. I know that's kind of snarky to say. We do. We have really good customers that want to do a lot for their customers. So they come to us and say, how can I make this experience better?
Yeah.
And, I'm not saving puppies. I'm not reading to orphans for a job. But if I can make an applicant's life a little better, especially in the small business space, I've got a lot of friends who own small businesses.
Yes.
And, you're doing 60, 80 hours a week anyway. When you need that line of credit to further your business, to take that next jump, and you look at a 14-page application, and you're like, well, when am I doing this? I used to give a presentation where the photo of that slide was somebody in their jammies with a laptop in bed. The only light was a glow on the laptop. Their spouse was asleep. I'm like, this is when small business owners have time to do anything, right?
You guys relate, right? Yeah. I mean, that is when. Then it's 14 pages and it's full doc.
Totally.
And it's nonsense.
You're searching through QuickBooks. Where do I get the report for this thing, right? And why do I need a resume for something that I've never, I'm an entrepreneur. I don't want a resume. I want a business. So now
Right.
I've got to make a resume to give to this lender who's just going to file it under check, turned in resume.
Turned in the
Yeah, I don't get it.
All right, so tell me how you came aboard FICO. What was it in your skill set,
Yep.
besides being devilishly handsome? What was it your skill set that where they said we got to have this guy and put him where you are now?
Right. So literally decades ago, sadly, I was in
Millennials weren't even thought of yet.
Yeah.
Your parents weren't even thought of yet.
Literally 20 years ago, close to 20 years ago, I was in the collection recovery space. I was working with debt recovery and companies like that, like the FICO customers that are now FICO customers,
Right.
with a legacy company called London Bridge. They're a British company, had an office in Atlanta. That's how I got hooked into this. Then we moved me into the origination space, which was good, and then I started.
Tell our listeners
sorry.
what are originations?
Yeah, so anytime you want to open a new account, right? Be it whatever type of account. I don't say we do loan origination, line of credit origination, card origination. It's just when you want to open a new account, or when you want to evaluate the credit worthiness of somebody to be able to offer accounts. That's originations. It can be deposit account origination, a loan, line of credit, business line of credit, personal, consumer, auto. Anytime you're filling out paperwork going, I need more money for something, I need to buy. That's originations in my book. Yep.
All right. And so now you moved into the
originations
department.
I moved into that department and then got connected to this product called Liquid Credit. Now, whether that's a boon or a bust or a curse, I don't know, but it is reality today. So, and Liquid Credit was cloud before cloud was cool, right? We were doing this web service thing back in the early 90s when nobody was doing a web service thing.
You're the man who invented the cloud. This was pre-cloud technology.
Seriously, it really was. The idea was based off of a client server solution that we had called Credit Desk. And everybody loved Credit Desk because you type in name, address, serial number, hit a button, and you get credit information back. And it would give you a rudimentary decision to start. And this was used by all kinds of small ticket lenders in the consumer and small business space. And then we said, well, client server's kind of going away. What can we do? Ooh, web services came out, API calls, all this stuff, right? All this quote unquote modern technology. So we moved it to these server sets up in somewhere in Minnesota. And started it there.
It's really cold there.
Well, it keeps the servers cold. Exactly.
You don't have to spend a lot of electricity up there. Well played on their part.
Yeah, and then we a couple of years ago moved it to an official cloud, the FICO Analytic Cloud in Chicago, or outside of Chicago. So that's sort of how I got into this.
And Liquid
Credit. Liquid Credit is the platform that delivers the SBSS, the Small Business Scoring Service.
Because that's what
product,
I talk to, that's what I talk to my students and my clients about. My podcast is SBSS, which stands for the Small Business Scoring Service.
Yep.
But that is
delivered on Liquid Credit,
the Liquid Credit platform,
right? Because
SBSS is actually the algorithm, or is the scoring model. Model tech.
Okay. Yeah, and models, it's more a suite of models, but we'll get into that later. But yes, sometimes a bank will say we have, we use Liquid Credit, and it's kind of like asking for a soda down south, right? Can I have a Coke? Yeah, what kind? Right? Oh, you use Liquid Credit, consumer or small business, because we have pooled models for both.
Got it.
And then you've got to, dive an extra layer deep. It's usually SBSS, but sometimes consumer. So yeah, hundreds.
Liquid Credit is the platform.
It's the delivery service.
Got it.
Yeah, the technology behind the models. Yeah.
All right. So Liquid Credit. So tell me then, how long has that Liquid Credit to SBSS conjunction been around?
Early 90s.
Coming from London Bridge. London Bridge.
And I came over.
They swooped you up. They just saw.
Yeah, I came over in 2001.
Got it.
But the product's been around since the early 90s. Yeah, London Bridge got purchased by FICO.
That's because they held the Liquid Credit stuff.
No. That was Liquid Credit's a FICO thing.
Okay.
They bought us for the debt collection software called Debt Manager.
And that's what's downstairs right now that's been blown up over the last 20 years.
Yeah, yeah. It's came through series of iterations, but yeah.
And for everybody, they have FICO has this massive how to actually compassionately and intelligently collect debt. I mean, I've seen their presentations on it. It's brilliant. So those are your origins.
Yeah, that's mine. Yeah,
got it.
Yeah.
How does SBSS, the liquid credit, how does that differ from like what people know as the Paydex score or the IntelliScore from Experian?
Yeah. So Paydex is D&B's health of the business score, right? IntelliScore is Experian's health of the business score. Those are actually probably more of an equation to the FICO score. The FICO score says that the consumer FICO score says how have they treated all of their credit in the past, right? The Paydex score and IntelliScore are going to say the same thing. How have they treated their credit? What do they look like from a credit profile? And that's good. Those are great scores.
Now, he's being nice because I haven't opened up yet. I haven't opened up on our experience of it. But please.
So imagine my analogy here is those scores, all of them, tell you how much freight is on a truck, right? How much payload is on the truck and how it's managing that payload. The SBSS score says, wait a second, this is an applicant. These are credit seekers. So you're going to put more payload on that truck. Right. At what point do you blow the tires of that truck, right? So we're kind of going, well, if you put what you're asking on the truck, you're going to ruin the truck.
Right.
In other words, this is going to be a bad decision, right? It's they're going to go delinquent. They're going to, we predict they're going to, a certain percentage of these are going to go delinquent, and that's what SBSS does because we've looked at every, hundreds of thousands of accounts pre and post new credit, and we can sort of tell to the statistical significance, predictiveness, to say these are the ones that are going to score low, these are the ones that are going to score high, and these, and the low scores you may want to avoid as a financial institution, because once you put new payload on, you start blowing tires. And that's
the borrower, tax the business.
Exactly. There's every business with stress, every borrower with credit has stress, meaning there's a certain give point, right? There's a certain point between income and credit that you just start going south, and that's what SBSS is geared to tell you.
Well, as all my listeners already know, he is being extremely kind and generous towards his competition, or not competition.
Well, co-opetition. I hate using that buzzword. Yeah. I mean, FICO and Experian have a great relationship in several and different levels. D&B.
You guys are already buying their data, right?
Yeah. Well, yeah. We coordinate with the data. We partner with the SBA to deliver both portfolio analysis of how much credit risk is in the SBA's existing portfolio, and that helps protect every tax. Exactly, are ready to go, right? And frankly, the SBA is chartered to bring on riskier trucks, so we need to be very, as taxpayers, we all are involved in that, and that's, there's a point of pride. Frankly, I get to be part of that. I get to go present those scores and talk about how we're.
Are you still a liaison with the SBA?
Right? I've
administration.
Met with them a couple times this summer. We always go in December because the fiscal year ends September. They give us a data dump, or they give D&B a data dump in October. D&B gives us the data dump. We score it out, and we go meet and present that sometime in the winter to say,
last year.
Yeah, exactly. This is every account in the portfolio, and how risky is it? It's really cool, and as part of their lender oversight program, and it helps it helps protect that federal tax money that we all contribute to,
we're
right?
We're all paying.
So that's my point of pride. Yes, I help Goldman Sachs make billions of dollars too, but I will protect I will protect the taxpayers in this one corner. Yes.
The reason why I'm kind of chiding the others on the personal side, Fair Credit Reporting Act, you have reporters and you have scores, and they're not the same entities,
right?
But on the business side, because business credit reporting is, as you said in the last time we met, is the equivalent of the consumer credit scoring in the mid 80s.
Yeah. It's not. It's probably gone last year. It's probably 89. Jumped up a little. Yeah, 89, 90. And that's from a regulatory perspective, right?
Right.
There are not as many boundaries to that.
Protections for borrowers.
Yeah, when we did a marketing score out using the SPSS score with a bank, and their lawyers were freaking out when they included the consumer credit, because with that comes all the federal regulations of the consumer credit, right? So we trimmed that out and just used the business credit, and that just went through fine. So because there aren't, it's a business, right? It's a much different than consumer entities.
The reason why I bring it up is because D&B scores its own data.
Yep.
Experience
scores its own data.
You can't do that on the personal side.
No.
And I don't want to go into collusion, right? Where profit motivation.
No. I mean, every company's profit motivated.
But the idea is that those scores are becoming what is, and you don't have to answer this because you do have amazing relationships with all of these vendors, but they're the D&B and the IntelliScore with Equifax and Dun & Bradstreet's Paydex score. They are health of the business.
Yeah.
But they don't list utilizations. They don't list the data points necessary to create a clear picture about even the health of the business.
Well, the data,
from my perspective, as a borrower and as a user,
but
being scored.
But their analytics take that into account, right?
Got it.
So, and that's something even the SPSS score, people say, well, does it take X piece of data into account? When something isn't taken care of in the model, a characteristic taken care of in the model, that's when the bank will use it in a strategy. Now, the model is going to evaluate that piece of data the same way every time, right?
Right.
If you score this value, you're going to get this many points. This other value, you're going to get more points. In a strategy, it's not, that's up to the bank, right? So that's when you're like, well, this bank said my utilization level was fine. You're saying it's high. What's the deal? Well, it's strategy. It's through the door population. It's risk tolerance. It's what they're used to for each individual institution.
And guys, that's why we vet banks, why we vet the lenders individually and regularly, like quarterly, to make sure that a program or an offering or a strategy is still the same thing now as it was before.
Yeah, right? We've got a customer, not a new customer, but a customer that's putting in a new loan origination system. And they're taking that time, which is brilliant, to assess all their strategies, right? What does the new technology allow us to do better, stronger, faster? And in that, their customers will experience differences because they're going to improve their risk strategy. So those that were marginal previously,
maybe green-lighted,
maybe declined, depending on how they were marginal, right?
Okay.
So
Well, so to that point, how does Liquid Credit, the SPSS, how does it use the personal data of the personal score data and metrics, and then what does it use from the business, from the business information?
Yeah, so there are 4 areas of data that the SPSS models use. One is the consumer credit of the
and that's the FICO
principles.
40, or does it use just the score and rely on the score as the heavy lifting?
The score is one input, and then we're looking at things like utilization rate and other things, major derogatories, or have you ever been 90 days late, greater than 120? What's your utilization rate? That kind of stuff. The basic credit stuff, because small businesses, and the smaller the business, the more this is true, react and act like the business principals, not necessarily the owners,
Absolutely.
but the owners and everybody else in the company.
Yeah, we
And so-
say that it is that the reason why the personal modeling, that's how FICO has used literally hundreds and hundreds of millions of transactions to evaluate the predictive, be able to predict borrower behavior en masse, but be able to take that data and say, oh, by the way, how they treat this money is how they treat
every money,
all the money, right?
Yeah.
Every dime, the OPM of it all. Right?
The literal exception to that was what they call strategic defaults after the Great Recession.
Yeah.
And even we had to dig deep for that. But it's a psychology score, basically. It's not a willingness to, it's not an ability to repay, because we don't necessarily look at every bit of financial piece of information on the business, but it is a willingness. It is a psychology score. How do they treat their credit? Loosey-goosey, not so loosey-goosey, and depending on the bank's credit tolerance, you may fall into that, you may fall out of that.
Right.
So, but 4 areas: the consumer data for the principals, and our score can look at 2, and we pick the worst one.
Right.
So, because we did
of the 2 submitted,
okay. and we ran all the numbers, and that was the most predictive, right? So it's not an average, it's not a blend, it's not the highest, it is the lowest of the 2.
They're usually the one in charge of finances.
No, I don't.
You know how we're good at everything.
Right.
We don't do it for ourselves.
No, but it's just when there's, I don't know, when there's a fly in the ointment, there's a fly in the ointment, right?
Right.
For lack of a better phrase. And then we look at the business bureau. That's either the Experian report or the D&B report. We do pick up the Paydex and Intello score, but also other things, right? We're looking at other aspects.
The score actually factored into the decisioning, the actual D&B Paydex
score. It's a
score.
characteristic in most of the models. I won't say all the models, because when we talk about SPSS, the version 7 score actually is a suite of 79 different models with various data points, right?
Got it.
So the other data elements called what we call application data, and that is years in business, owner's net worth, what's your current checking and savings balance, kind of things, and
SIC code or the type of business or the industry.
There is in version 6, there is one model that has that. What we found is, unless you're a startup, the industry doesn't matter. If you can survive the first 2 years, exactly, right? Most small businesses act the same and will react the same in general.
Now, is this an SPSS perspective? Because I know that lender underwriting software
is a modeling perspective.
Okay, it's modeling.
Yeah, modeling.
Because I know that, like you said, the lenders, they have strategy, and they look at some industries as pariah.
Let them take care of that, right? Bank policy and bank strategy.
Okay.
Again, from a modeling perspective, we found
2 years and you're good to go.
We found it not to be predictive, right? Except for in our startup models in version 6, which is pre-recession. And I'm just explaining that. I don't know if pre-recession has anything to do with it, but the new model said it doesn't matter.
Okay.
So because we look at over 300 characteristics when we build these models. And by the way, smarter people than me build these models. Please don't think I'm over there crunching this stuff.
They're in the meeting hall store to us.
These men and women.
We're the aggregators of the
No, I just talk about what they do. These men and women are brilliant. They know what they're doing. It's amazing to watch them work and listen to them talk. But they look at 300 different characteristics.
Who's in charge of the SBA relationship?
No. Again, I'm a relationship guy. I'm not smart guy, right? Please don't tag me as intelligent. I like to joke to say I'm Coco the gorilla who can sign language and ask for grapes, right? Compared to these mental giants that I work with. Work with a lady, Michelle, who's just brilliant. Oh my God, she's so smart. Anyway, so we look at hundreds of characteristics and we pick out the ones that are the most predictive, that give the most weight, quote unquote.
Right.
And we use those. And SIC code didn't make the cut this time. Will it make the cut next time? I don't know.
We're gonna
That's,
do another-
we
we'll say pre-recession.
yeah,
again,
exactly.
so-
Right. But we let the data talk, right? We
Right.
let the data tell us what's
It's
predictive.
relatively unbiased, even though I just came out of a meeting, a presentation saying the polluting of data sets, so with bias.
Well, and that's where the heavy lifting comes, by the way, when it comes to building these models. You've got to filter out the noise, right? Before you start building the model. Otherwise, you're driving to a specific course, and we don't want that to happen. We want to, this is sort of like, take us wherever you want to go model, and it does. Where if you don't filter the data, if you don't really get rid of all the biases in the data, you're going to end up with a bad product.
You're going to end up in New York City,
totally.
Midtown,
Yeah,
in the middle of
and nobody wants that.
Nobody wants
that
right now.
Yeah.
Yeah. All right. So see, that's really helpful because I've known that SIC codes, the NAICS codes, NICS, are vital, but I didn't know how it related to the actual SBSS.
Yeah, and
modeling,
again, it's a modeling thing. The strategy of the bank, they might not want to touch industries. They, come on, we all know there's some industries that
I can't look at you right now.
That are painfully underbanked, and rightfully so. And there's some industries that the banks will want to do business with and just can't. The marijuana industry out in Washington, people, there's so much money in it, and bankers are capitalists. They want to get to that money and just literally can't. So there's we've got to wait
because there. What I was understanding is that truly non-national bank charters, meaning the local tiny ones,
tiniest of banks,
who can legally do it within their own state.
Yeah, but if you're a federally chartered bank, you can't touch it. Yeah,
right. That's hilarious. And these guys are like these banks, these little tiny banks, mom and pop banks, we call them, and they're like everybody's going to them for the money, and they are high. These are high net worth individuals who are going in high returns,
high something another. Yeah, but I've literally read about these small banks having to launder the money. I mean, literally put it in a washer and dryer because it just reeks so much they can't put it with their other money.
So we're back to the original definition of laundering.
Right.
Like putting it in the dry cleaner or in the washing
just to
machine.
get that, just got the smell. But no, that's
I'm high counting my dollars.
Exactly. Funny conversation, but really it's true. We've got a bank, potential customer out in Washington State, and they're like, we don't want anything to do with this industry. So they're checking boxes to totally avoid it. So if you're in any way related to it, you have to stay away.
Yeah,
because they're just fearful of it.
And there's 5,400 at my last count. I just downloaded Wikipedia.
Tons.
5,400 banks in the United States that are federally chartered and can't touch that industry.
Yeah, and it's a legal industry, and let me say this: a lot of things are legal industries that banks don't want to touch, right?
That's what he means when he's talking about the strategy.
Yes,
right?
The strategy
versus pure data modeling.
Yeah, and there's also just industries that banks haven't had good experience with, and they just don't want to deal. So I mean, and there's personal underwriter bias too. Of man, another one of these. I've lost my shirt.
Isn't that what AUS is? Automatic underwriting systems are trying to get out of. Is that that 70-year-old banker who says, "Not you again, mister. I knew you when you were 20. I still don't want to do your business when you're 50."
Well, and I talk about human bias. It's not a bad thing, right? We all have bias, and bias can be positive or negative, right? I have a bias towards Indian food. Well, I have a bias towards a lot of food, but I have bias towards Indian food. It doesn't mean I don't like other food, right? There's some things you can have a bias on, some things you can't have a bias on. But when the concept of going to different underwriters and getting different decisions on things, that's on the way out. The bank wants to treat everybody the same because, again, it talked to what we talked about pre-podcast is the customer experience, right? I want to be able to apply here and get the same answer from anybody in the bank, right? Whatever branch I stop by, whether it's the East branch, the West branch, wherever, I want to get the same answer. And that's, central decisioning, automatic underwriting, all that stuff is headed to it. Now, in the small business world, people hate the word automation. I try to say expediting, right? Because not everybody.
My borrowers, clients, and students that we're all in. You give us a model. comport our behavior to the model,
Right.
approvals are await.
My presentation here at FICO World, the sole reason I'm here, I believe the thing's titled "Why Small Business Lending is Terrible and What We're Trying to Do About It," because a good friend of mine called me up one day. I mean, I've known this guy for 20 years. Our kids have grown up, right? We know each other. Slept on his couch, for goodness sakes. And he goes, "Dave, I just applied for a $50,000 business line of credit to the bank that I have hundreds of thousands of dollars in, and they handed me back a 14-page application and wanted a ton of other documents." He goes, "They don't know me. What do I do?" And his big question was, is this the regulation demanding this? Is this what everybody goes through? Or is this what my bank is putting me through? And at that point I said, that's your bank, man. Everybody faces the same regulation, but if you go to bank X, Y, and Z, you're going to get an automated system. You're going to get a quick, at least a go, no-go answer within hours or seconds, right? Hey, we can do business, but you need to complete this other stuff.
So I want a deeper dive there. So what I tell this story. One of my clients, we call him Tennessee Tom to maintain his privacy, but he banked just like your friend. Banked at this bank for 7 years and made his deposits, did his thing. The only people who knew him in the bank were the tellers, right? Yeah. 7 years. And then we started telling him how to optimize certain things, certain traffic patterns in his deposits, and all that stuff. And one day he walks in and the bank manager kind of scoots right out of his office and said, hi, Tennessee Tom. My name is I'm the bank manager. And he's like, what have you done?
Right.
What did you guys do? And I said, this is where the automatic underwriting systems hit the real world. Yeah. And the email goes to the bank manager, say, this is a person of interest.
Right. Yeah, well, my friend, who will remain nameless, and the bank will too, by the way, was told during the borrowing process that they were one of the top 3 deposit accounts for that branch. And they were still treated like anybody who walked through the door.
Yeah.
So
I totally get it. Totally get it. So that's one of the things that I wanted to ask is, what is it that in the underwriting or in this modeling process, what are the general performance indicators from the personal profile? Personal credit. We were going through the 4 areas.
Yeah.
One was the credit from the principal.
Yeah, I don't think I ever named the 4th. I don't think I ever named the 4th.
Finish that.
Financial data. So it's like
financial data from the personal or
from the business. So it's EBIT to interest rate, it's debt service ratio, it's quick ratio, current ratio. Those things need to be within a range. Now,
are there
Google the range? Yeah.
There's typical. I mean, there's a window because I don't want to.
I don't
NDA all of our listeners.
I don't keep those things in my head, to be perfectly honest, and they certainly don't give me access to the code, right? But no, just literally Google quick ratio, current ratio, and you'll see what a good one is and what it's not. Now, try to stay away from the extremes. Try to hit in the middle, and you're solid. Literally call your bank and say, what kind of financials do y'all look at, and just tell them to me, and then just literally go Google them or Bing them, or I don't want to be.
Is when we've trained our borrowers, and we'll tell them certain structures that are being measured, but the thing that is most fascinating is that when they ask they only have access to the loan officers. And the loan officers are, yes, bring it. And then they send it to underwriting. They're like, oh, sorry.
Well, again,
so that's why.
Figure that out. Talk to the business developers, the loan, the person you meet at the bank, the person that shakes your hand. You need to say, hey, I need information, and I need information from somebody, not from just general. I need just any information
with your other
exactly
business development guys.
Right. I'm not here to get muffins or bagels. I'm here to be told information.
We're going to add that to our vetting list.
And what's funny is the fintechs. If you go out to a fintech lender website, they will tell you straight up, you need to have this much cash flow. You need to be in business this many years and X, Y, Z. And you go, oh, I have this. Oh, I don't have that. Won't apply to them. I have this. And you just keep flipping the pages. Whereas a bank doesn't necessarily do that.
He's telling you how to be more effable, guys.
Yeah.
This is awesome.
Go figure it out. And cheapers on the Google page, it tells you straight up in the little ads on the right side. It's yeah. Awesome. Yeah. So anyway, back to that.
Quick question.
So consumer credit, right? Consumer credit, in light of being a small business owner, your credit generally sucks more than the average consumer, because especially the newer businesses, you've utilized your personal credit to buy office paper, to buy stuff,
right,
to get your business on the up and up, and congratulations, right?
And if you don't know the difference between business and personal, you're putting on your personal rather than getting a business card.
Exactly.
Just to keep it off the personal rating and ruin your utilization, right?
And I understand that has to be done sometimes, right? And so and these banks kind of understand that, to where, you've had to drop 20 grand on your Amex just to cover payroll, or just to cover this, or just to cover that, right? The quick advice is get it off as quickly as you can, right? Without risking or ruining your business, because the small business lenders understand that, whereas the average consumer has a 715 or whatever, an average small business owner is going to have a 680.
Yeah.
And that's okay. It's not stellar. We prefer 700s, but we get it, right? We totally get it. You're mixing your credit, and that's great. The first chance you get to get business credit, grab it, use it.
You heard it right here.
And cycle it. Use the mess out of it to make this a G-rated podcast, but use it, and use it a lot, and pay it off and pay it down, and get to where,
traffic,
again,
guys. He's telling our language. Put traffic on the put traffic on those business instruments, so they continue to stay active,
to where you protect your consumer stuff. Because what we found, again, recession, right? During the recession, right before recession, as things started getting bad, business credit utilization spiked. But then again, so did personal credit, because they ran out of business credit. So now they're having to throw everything on their personal cards. And when post the .com, and I'm dating myself, or post the .com bust, where and during recessions, I can, as a small business owner, let's say I put out my shingle as a consultant, or I'm selling widgets or whatever, there's usually another job to go to, right? If I'm a consultant in the IT world, I can always go, okay, this isn't working, and go to another firm. Well, that's not always available. So when that's not available, people start using personal credit, and then they get in this cycle of they don't survive. The business goes bankrupt, then they go bankrupt personally, because they've just thrown all that stuff on their personal credit, and they can't. It's a 7-year recovery period at that point. So don't let if I hate saying it, let the business go. Don't strategic default in the business, but don't ruin your personal credit for your business. Ruin your business credit and pay it off. I'm not saying just walk away from it, but I am saying that once you start mixing the two, you mix the two to start, and then you mix the two at the end when a business fails.
And that's the whole strategy we're teaching I'm teaching all of our listeners, is how to literally build them independently from the beginning and forever.
Because one of the portfolio evaluation tools that we tell banks to look at, meaning once you've got an account on the books, they're going to measure you monthly or quarterly, some annually, but usually quarterly at least, to say, how is this business doing, right? We see how they're paying us back. That's a yes, no, thumbs up, thumbs down. But otherwise, how healthy are they? And they're going to grab your consumer credit. It's a soft pull. It doesn't hurt you. But if they start seeing the personal credit utilization start to spike, that's a warning sign. That means they're using personal credit to feed into the business, and that's a danger. So then you're going to start getting those phone calls. Hey, how you doing? Don't pay up.
Tom has a whole new
exactly. Totally.
Okay, so we covered the four: the principal, the
consumer
from the principal, the consumer credit from the principals.
Yep.
The business dynamic, the business metrics of the health of the business.
Paydex, IntelliScore, those reports. The application data.
Pulls both of those.
Nope, we pull one, and that's up to the bank.
So they choose just like they do the personal bureau.
Yeah, we're data agnostic is the phrase, right?
Great term.
Because we work with everybody, because we don't hold data. We're not a credit agency ourselves.
So you're literally running the report based on who they're pulling from.
Yeah, we literally knock on the door as the bank to get that credit report from D&B or Experian.
Okay.
Yeah.
So third one, then
application data.
Application data.
So the time
syncs up with the databases.
Yeah, no, it's reporting. It's what the banks tell us. We don't go check it. We're not, how long have they been in business? We don't check that against a D&B. We don't check that against Secretary of State. We expect the bank to have vetted that information. So owner's net worth, we expect it. We expect the bank to go, really? You're 22 and you're worth $37 million? Yeah.
You do the math between the fields on the
exactly.
Okay.
Yeah, we assume that all the data that we get is vetted and appropriate.
So that's real, but lender software and Intel is supposed to decide.
Yeah, they're supposed to decide. Yeah, the whole application process. That's why it's so daunting. Is it just is. I mean, but again, if you're making claims, we had one SPSS user call us up and go, y'all let this 19-year-old kid, tell us he was worth $10 million. I'm like, we didn't tell you anything. We scored it according to what you said. And then he took the equipment down to Mexico and sold it. So,
all right. Well,
sorry guys.
You guys need better vetting, right?
Yeah.
All right. And then the fourth one, the application score.
Financial data, right? So basic, it's asset liability, profit loss statement stuff. It's debt service ratio, quick ratio. Okay. There's about 6 ratios. Covered all those 4.
We're using this as an amazing bully pulpit over exactly what's happening out in that market.
There's a 5th element, which this is
great
more
movie.
Yeah. It's more of an interbank thing, right? If you're not in the banking industry, you're not going to know who these are. There's a Small Business Financial Exchange, which is an independent data consortium with a bunch of bank partners that get bank level data, right? So your trade line
early warning.
No, it's more data on the loan. So a trade line on a credit report, that's all of your accounts, right? So your Amex account is a trade line, your auto loan is a trade line. That's what that means.
Right.
That'll tell you, are they paying as negotiated, right? Meaning, are you making your minimum payments? Are you doing it within the expected date? Whether these are monthly or quarterly payments, annual, are they current? And then it'll say what's the original balance, what's the current balance, and then what's the payment, whether that's quarterly or monthly or whatever. And that's all they tell you, right? It doesn't say that, well, last month minimum payment was $300 and I made a $15,000 payment and dropped this balance down tremendously because I'm doing well, right? Well, that's what SBFE does, because the bank reports back to SBFE a bunch, like 40 or 50 more pieces of data.
Tell them what SBFE is.
Yeah, Small Business Financial Exchange. It's a data consortium where banks give and get, right? If they give a loan to Sally's plumbing company, then and she banks with Bank X. When Bank Y, who's also a member of SBFE, wants to lend to Sally's plumbing, they go to SBFE and say, tell me what other banks know about. And it's got more information, like did they make a big payment? What's some of their balance information? Give me something deeper. Do they pay early? Do they pay a little late, but not late enough to report? Because there's a 31-day payment, right? That's not, I'm sorry, 1 day late is not 31 days late.
Correct.
So it's just slow payment. So how are they paying? And SBFE provides that information. You don't have an account there. You can't go get an account there, but it's nice to know it does that. And then D&B sort of has its equivalent called SBRI, Small Business Risk Insight, which is, again, 40 or 50 different bits of data. And we have flavored models on that data. So,
and those are contributing to this last section.
And it's all bank level data. So all you have to do is take care of your bank loan and you'll take care of that, right? So that's just downstream. Yeah.
Fascinating. Yep. All right. So to wrap this up, I wanted What types of lenders are the early adopters for liquid credit? Who's are tier one banks or the big ones, the mom and pops? Who's doing this?
So these are pooled models, meaning we build these over a couple 100,000 accounts on various. We basically pool a bunch of portfolios, right? Hence pool models, to get that couple 100,000 accounts. Because the Bank of Americas and the Chases, they have hundreds of thousands of accounts all by themselves. They have floors of analytic teams that can go build models, and they've got their own nerds, and that's good. And they have their own what's called custom models, right? The mid-tier banks are going to have an analytic team, and they're going to have a good-sized small business portfolio, but it's not their thing. So in certain departments, we hang out at those mid-tier banks, meaning the top 50 banks, right? The 25 to 50s. We do work with PNC. We do work with Fifth Third, M&I, M&T, those level of banks, right? They're big banks in the grand scheme of things. Let's not understate.
We call them tier two.
Yeah, exactly. Mid-regionals, mega regionals, whatever you want to call them. Renaissance Bank is another great customer of ours. And they're, all over the Southeast, right? And they tout to be a small business bank. But it's those organizations that say, look, we just don't have enough of in our portfolio to build a model on it. Because the irony between the credit risk team and the model build team is the credit risk team doesn't want to have bad accounts, but the only way to build a good model is to have a lot of bad accounts.
Have a true percentage of bad
exactly.
accounts.
You have to have, and it's 300 bad accounts is what our modeling team says. A credit risk manager will not have a job when they approach 300, right? Not even close to 300. So
you're fired. But
our model is awesome. We've got a model that just beats everybody. But please leave. So it's the mid tiers and below, right?
Right.
It's all of those.
Chase, Wells,
they're good.
They're doing
they're
good.
good.
SPSS by and large because they only have their own internal analytics.
Yeah, and then we play well in the equipment lease areas within some of those larger banks, right? The PNCs, the Fifth Thirds, the BB&Ts, hundreds of thousands of those. They'll never use our commercial card because they've got hundreds and thousands of commercial cards. It's the smaller banks, it's the community banks, it's the 6-branch bank in West Texas that goes, we need something, right?
We want to
know
this principal business is doing,
and we want to look at it from what's called a blended perspective, so the business data and the consumer data, and we want it based off something bigger than we are. We can look at our underwriter's decision. So where do we have this? That's the SPSS score.
So that's tier 2 in our nomenclature.
Tier 2 and below.
Tier 2, tier 3 are the sweet spot for SPSS, liquid credit, etc. So now this could be a professional, this can be a personal answer, but what is the adoption model for these tier 2, tier 3 banks? How long until you guys really have taken over business scoring like you have the personal scoring?
Right.
Dun & Bradstreet, it's selected by whose businesses are adopted inside of. Just even a personal. I'm not holding you to anything. Yeah.
So the FICO answer is, we're our partnership with the SBA really drives a lot of this business, right? Because once they say, well, the SBA is using it as part of their, call it a low doc. It's legit, right? It's literally been vetted by Congress, literally. So I can adopt it now too. So what's causing this increase in adoption is it's the SBA, because that makes it easier within the regulatory and the legal aspect. But really, it's the fintechs. It's the on decks. It's the Cabbages. It's all those folks.
The SoFis,
which are making. I type in 8 pieces of data about me and my business, and I get an answer back within seconds. Yeah. That is crushing the community.
Dozens or hundreds of thousands.
Yeah, exactly. I can get up to $250,000 at on deck in a matter of minutes. Right. And Cabbage says they can fund your PayPal account in 7 minutes. Literally, seriously.
That's SPSA or SPSS.
No, we don't
do
we don't
fintechs?
touch. No, we don't. Yeah, they don't do us, right?
Right.
They've got their own analytics.
That's why we call them fintech.
Fintechs,
financial
right?
Technology
Yeah, financial
companies.
technology. They're coming in hot and heavy. They've got their analytic team. Some of it works, some of it doesn't, right? But they are the canary in the coal mine, right? Let them go test something, for good or bad, right? And then we adopt what's left.
Right? Their massive failures, and everybody here is like taking notes.
Yeah.
All right, we got this, right?
No,
guys?
it is. It's they've walked through the minefield first, right? And some of them survived, some of them haven't. But those that survive, you're like, hey, I got to follow that path because that works.
Right.
So what's happening in the community banks and the mid-regionals is that small business owner says, this 14-page application isn't worth it.
Yeah.
And again, this is the story I'm telling at FICO World this year, is it's just not worth it. Where is an easier decision? And so I will abandon my community bank and go to somebody else. Go to the fintech, go to the captive lender, go to whoever, right?
Fishing for. The fintechs are fishing.
They're dying for it.
Those guys right there.
And the small business owners are willing to pay more for that loan because time has value. Yeah. Imagine that. So my customers are coming to me going, how do I do this? And the answer is start small, right? Start at the $50,000 to $100,000 level. Get an automated or expedited process for that. Right. Get comfortable with it. Use SBSS as part of that and get comfortable with it. Then once you're comfortable with it, once the bank can see, hey, we're not losing our shirt, go up to 150,000, then go to 200. Because the SBA uses it for their 7A program for 350 and below, $350,000 loans. So,
but the model isn't. You told me the model goes all the way to $1 million in.
Yes, it does. Yes, it does.
Right?
Now, FICO here is telling you, yeah, you better not be giving $1 million away to a small business just on that score. That's where the strategy and that's where the SBSS score becomes a piece of that, right? So the SBSS is one of many things for that $1 million decision. And what I'm saying here is, if you apply for $1 million, expect to turn in paperwork. Right. Come on, guys, gals, we got to do this. But for 50 grand, that's a credit card decision. I literally told my buddy, I said, go get a Spark card. They're going to give you 50 grand, 35 grand, because I know your FICO score, right?
But tell your friend not a Spark card, because it's going to report to your personal, because no capital instruments report only to the business.
Yeah.
So
he's a young business. I was like, if this is what you need to do, go do it. I said, truthfully, self-fund or go to a captive, right? He wanted some just general fundage. Ended up buying some capital, and he went to one of the lenders on the website for that particular. They were in film, so they did a camera. And I said, well, go see what lenders they have available for the camera, since this bank still is dragging their rear end on you. And they did, and literally, it was a funny story. I mean, he's talking to me, and he goes, guess what happened yesterday? I said, what? He goes, as I got the cameras from this fintech, because this lender had a relationship with the service, and they ordered the cameras for them. Now, it's a great service. In banking industry, they just collateralize the loan, folks. It's just an easier loan to give when I know, I'm lending you $30,000, but I specifically bought $30,000 worth of stuff, and I know where to go get it if I need it, right? So it makes for an easy loan, but still, I talked to one person, and so he's literally unboxing these cameras when that small community bank calls him and says, hey, I think we figured this out. He's like, yeah, I did too, right? I did too. So what's driving all this is a fintechs. What's pushing banks to go, you know what? We're losing our shirts in this arena.
Your business because they don't use you.
They don't use us, no.
But they're market makers.
Yeah.
Because everybody
they're creating that competition.
Like to stay with their relationship bank.
Yeah.
If they can.
They begged this, That's friend awesome. Begged to stay, but eventually it was like, look, this is ridiculous.
That is awesome.
So yeah.
So what, how long, that was my main question was just how long do you see for this adoption?
Yeah.
It's being driven by fintech.
It's 3 years. In my head, it's 3 years because the technology cycles, right? Everybody's old technology has to be replaced. And nobody's replacing old technology with yesterday's technology, right? Because companies hold on to loan origination systems for about 10 years. And every time you recycle that, you're grabbing the next best stuff. And if I can do that, if I can automate something where I can, right? The banks are going to choose to automate it. But yeah, I want to take a 14-page application down to a 3-page application and decision that in 3 hours, not, 3 weeks or 12 months or whatever.
Right.
So yeah, that's, I think 3 years, and that'll cycle a lot of the old technology out and get some new mindset in, and you're going to start seeing new examples of things. By the way, I do want to talk about, there's an organization out there called finreglab.org, and they did a fintech study because these fintechs are going in and looking at cash flow.
Right.
Maintain your bank accounts, folks. That's the next thing. Is
you heard it here first.
Don't NSF. Keep that stuff clean. Pump everything through one account.
That's non-sufficient funds.
Yeah, sorry.
Make sure you never
don't bounce checks. Right.
Don't bounce a check or a debit.
Thank you.
Put a zero floor on your debit card so you can't
bounce it.
Rejects you before it accepts it.
Yep. My daughter hates that, by the way. But
how old is she?
17.
Gen Z now, or is she an alpha?
Whatever that is. Yeah, whatever that is. But yeah, that's so they're looking at cash flow to say, is cash flow predictive? And they determined through studying 6 different fintechs that yes, cash flow is a predictive credit risk indicator. So again, that's the canary in the coal mine, right? You got to have the canary come back up and go, oh, this is good. So now they're taking that information and proselytizing it.
Yeah.
And banks, again, early adopters are going to get it first. Then 3 to 5 years from now, you're going to see cash flow, because I've been saying this for years. Cash flow is key.
Contributor to any score.
Do you know why?
If you have money, you can pay your bills.
No, that data's free. It's free and unregulated because you're my debit account, right? You check with me. I know this. It's free. It's right here. It's within the bank. I don't have to have your permission to check it because you gave me all that permission when you signed up. Right. It's free data.
What's fascinating is I teach our borrowers that the worst thing you can do is get a credit line that is a check guarantee card.
Yeah.
Because you want to put it on, you can put it on a regular card, but that indicator, every time you use that credit line, you're punching through zero, which is the free indicator you're talking about that says, these guys are using credit to pay what should be cash transactions.
Yep. No, and that's the utilization. That's when in the consumer side, when you start seeing like your utilities pop up on your credit card, you're using your credit as cash, right? As stuff that you should not be using it for, and you can start checking it out. And that's danger zone stuff that you want to stay away from. But the next thing is cash flow. The next thing is looking at your debit accounts, because we're even doing that on the consumer side. The ultra FICO score for the underbank is looking at some cash, looking at NSFs and such on the consumer side. So it's coming to banks. So keep them clean, have everything pumped through one account. Whether once everything's in there, then you diversify it out, that's fine. But show all of the cash flow into one account.
You can send the greatest traffic message.
Yeah.
The message is,
this is how much I'm worth to you. This is how much I'm worth to you. All my money comes into one spot. You can see it pile up. Now, then you see it disperse. Right. But that deposit amount for the month, your average balance, it's huge. Excellent. And that is very predictive.
Well, I did want to say this before the end of our the podcast, but if you notice, there is a halo over his head in this thing. So that's because
silly.
That's because thank you so much for being here and being willing. Remember, these guys, for very good reasons, keep a tight lid on your tech, right?
Yeah.
And so it really means a lot to me. At least we've met a couple of times now. Thank you for being willing to just talk to borrowers who are trying to literally walk the minefield without stepping on the landmines. And this is vital that we get this from you.
No, and this is missing in the small business credit space, and I'm glad you're filling it. So I'm more than welcome to come in and talk about it when I can.
Thank you very much.
I appreciate it. Thank you very much.
It's been wonderful.
Bye.
Guys, you have a spectacular rest of your morning, noon, or night. And Merrill Chandler, you are definitely more affable now that we finished this podcast. So you guys be well and have a wonderful day. Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.